Three quality stocks to buy near their 52 weeks low as the market's going up. It's making new all-time high. There's many amazing quality stocks making new 52 weeks lows. Some of them are making lows for good reasons. Some of them could be making lows for unjustified reasons. And this is what I'm gonna try to figure out in today's video. My last weekend video was about Berkshire Hathaway and FICO, two amazing companies making new lows. And while the market is making new all-time high, and they were very interesting opportunities, and I gave you my fair value on them. I gave you my opinion on them. So a lot of you guys enjoyed the video, and you asked me to do another one in this weekend, so I'm doing it now. I have three very interesting opportunities, especially the first one. It's a stock that I'm extremely interested in buying myself, so I'm gonna talk about it. Again, some of those stocks are presenting buying opportunities, but some of them are a little bit expensive, and I'm gonna give you my fair value so you can put in an alert on Yahoo Finance or your favorite website, and you could get alerted whenever those stocks get interesting, and you could review them and talk about them. So I really hope you enjoyed this video, but if you do, all I'm asking is please press the like button and let me know what you think in the comments. Okay, now the first one, it's a very interesting stock. You don't hear a lot of talks about it on YouTube, and this is Eli Lilly. Eli Lilly has been killing it. They've been taking massive market share from NVO. They've been doing so well. They have so many exciting things coming along their pipeline. The future is bright. The stock is down year to date. I mean, it's not down a lot, but the stock's trading near its lows. Over the last year, it's down 10%. So the stock has gone nowhere over the last years. Their earnings have grown like 82%, sales, massive jumps in sales, and the stock has gone nowhere. To me, this is very, very interesting. The valuation on Lilly is starting to get extremely interesting. I skipped the stock because the valuation was insane. The stock was trading at around 72 or 74 times earnings. Now trading at 30 times earnings, around its average multiple. So this is, again, very, very interesting stuff, and I don't believe a lot of people are tracking this one, but I'm tracking it very, very closely, and I really hope I get to buy this stock. It would be a core holding in my portfolio, and it's one of the best pharmaceutical stocks of all time. They have so many tailwinds that I'm going to talk about. It's a very innovative company, one of the best. So if you could get to buy the Eli Lilly, again, it would be an amazing buy, but they're experiencing amazing sales, jump in sales in terms of the Zepbound kind of business, which is related to weight loss and other kind of areas. Massive jump, around 2.3 billion, insane jumps. Same thing with Mounjaro. Mounjaro increased $2 billion. This is insane kind of sales growth, but the tailwind that's coming for Eli Lilly, and I believe they're 3 to 5 years ahead of the competition, and this is the oral GLP-1s. Now imagine what kind of a game-changing business plan is this, or what kind of game-changing innovation is the oral GLP-1. A lot of people, they just don't like needles. They don't want to inject something in their body. Maybe they want to lose weight, they want to manage their weight, but they don't want to inject something in their body. I mean, it's just weird. It feels weird, right? And some people, they're scared of needles. Now, what if it was an oral GLP-1 oral? This is a game changer, and NVO is behind them. I believe Pfizer has abandoned their plans to enter the weight loss category because they had some kind of a major, like a fatal failure in their trial, and they abandoned it. So no one is pretty much entering the space. It's going to take 3 to 5 years from my research to catch up to Eli Lilly. So Eli Lilly is ahead of the competition, and based on the phase 3 trial, they experienced a safety profile consistent with injectable GLP-1s medicine, which was a very successful trial. It's pretty amazing. Now, for commercializations, they expect to submit weight management to global regulatory agencies by the end of this year, with a submission of treatment of type 2 diabetes anticipated in 2026. Now, they're going to submit them by the end of the year, but I believe it's going to take longer based on other articles I've read. It will likely come online by 2027. So it's not going to be anytime soon where Lilly will start making money from those GLP-1 oral pills. But again, that's a game changer, massive tailwind for growth for Eli Lilly. And again, not many companies are doing this, and the ones that are working on doing this, they're 3 to 5 years behind. So this is again an amazing setup in the market where the stock has gone nowhere. The valuation is starting to revert back to its mean multiple. Not a lot of people are talking about this one. Everyone's buying Webull, they're buying the tech stocks, they're buying the big seven or other kind of companies. But Lilly, with such growth coming in the future, not a lot of people are talking about it. And to me, it's getting very, very interesting. Now, in terms of the growth, the company is growing rapidly. They're expected to grow 80%. No, they actually grew 80% over the last 12 months in terms of a earnings per share basis. In 2025 in total, expected to be around 86% growth. Next year is expected to be around 35% growth. And by the way, I'm using Fiscal.AI to come up with those charts and the PE multiple and even the screener. I use them to come up with the screener. I just type in whatever I want for the 52-week low and I get all those things. So if you want to try it out, they give you free access if you want to use my link down in the description. But for next year and for my model, I'm not going to use such high numbers. I'm only going to use 35% growth for 2026. So all I did to not make it too confusing, I used 35% growth for 2026. After that, I used 20% earnings per share growth, then 20%, then 15%, 15%, assuming it decelerates over the long term, which normally what happens with those companies, it tends to decelerate. Okay, the PE right now is 30 times. I put it at 25 times, assuming the PE ratio decelerates further. I believe 25 times is fair. If that's the case, the upside from here would be around 89% or 14% CAGR. Now, if I want to double my money with Lilly over the next 5 years, I would have to buy Lilly around $704 per share, which is only like 7.5% from here. So for me personally, Lilly is very, very close to a buy. It's extremely close to a buy. But I'm not buying Lilly yet because I am worried of a potential further multiple contraction. So Lilly now is trading at 30 times. I'm saying maybe the stock could go back to like 24, 25 times, which is fair, taking into consideration the oral GLP-1. But what if it goes back to the previous like multiples of 22 and 21 times? Then the stock would really get killed and I would, I would lose a lot of money. Now, if that's the case and Lilly goes back to, let's say, 22 times, then I would have to like pay $620. So that's why I'm a little bit skeptical of Lilly, so I'm waiting on it to see kind of what the stock does and everything and how the company performs. But I believe Lilly, I would say it's a buy right now. I mean, if you want to buy a small position, dollar cost average down. But for me, I'm keeping it on my watch list. I'm monitoring how the business does, what happens with oral GLP-1s. But to me, Lilly at this price at 25 times was my assumptions, and especially taking into consideration the deceleration to 20% and 15%, I think that's too low. So I believe Lilly right now is likely a buy. And I think it's a very interesting setup given where we are in the market, given the overvaluation, and given the concentration into the growth and not much into the kind of those recession kind of stocks, boring stocks. And I think once the rotation happens, Lilly will likely do extremely, extremely well. Now, the second stock, which a lot of you guys have been asking me about, and it's a very hated company. A lot of people like this one, a lot of people hate this one. And this is Adobe. Adobe is down 17.5% year to date. I used to be an Adobe bear. I mean, I hate the stock. It's down 33%. I never owned the stock before. But Adobe, again, at this valuation, to me, it's starting to get interesting. Now, if I look at Adobe's business model, the company has 650 million monthly active users, 650 million, 3 trillion PDFs in the world. They have the PDFs. They own the PDF that we all use, that everyone uses. Even Microsoft uses a PDF. Not they don't maybe use a PDF, but everyone uses PDFs. 3 trillion PDFs in the world. 400 billion documents opened in Adobe Acrobat annually. This is massive reach. This is like Meta kind of reach, TikTok kind of reach that they can monetize some way, somehow, if they really put their heads to it. So this is an amazing, amazing business model. And that's just the PDFs, 3 trillion PDFs. I mean, can you imagine? I mean, this is insane, guys. Insane. If they charge $1 per PDF or something crazy, or 10 cents, I mean, it would be insane. I mean, I would just only imagine. Now, the main thing with Adobe is the AI story, where a lot of people are saying that AI will kill the business model. But a lot of people on X, they're saying that AI will actually boost their business model. And based on the numbers that I'm seeing, I mean, and they're posting, they're saying that AI is actually helping them and it's not actually hurting them. Now, this is their existing portfolio where AI is helping them grow. And they say it's like 3.5 billion annual run rate. I'm not sure if I believe that. But this is a new AI portfolio where it was pretty much at nothing in 2024 and now it's at 250 million. So it's still a very small business, but it's growing in terms of their AI. So based on what I'm saying, AI will not likely put them out of business, but will likely help them. And based on the growth that I'm seeing in their creative cloud and experience cloud, the company is still growing and the growth has actually accelerated between 2023 and 2024. Even though we had AI, the growth has accelerated. And again, I'm not seeing signs of slowing growth, signs of a dying company, nothing like that. But I'm seeing a massive, it's just terrible sentiment around the company and their AI strategy. But I'm not seeing like a company that's just dying out. I'm not seeing it at all. Not even close. But if I look at the company's valuation, it's trading at 16.7 times earnings. 16.7 to me is extremely undervalued for a company like Adobe. It's very, very cheap, taking into consideration massive net income margins, around 30% net income margins. This is like a 97% recurring revenue business model. So most of it is subscription recurring revenue. This is pretty amazing. If I look at the company's earnings per share growth estimates, they're expected to grow like 11 to 12% a year. And this is something that I would expect to continue. I wouldn't not expect more, and I would not expect less. Now, assuming they maintain the growth, again, I'm trying to keep the video short, and I take the current earnings per share of 2056, and I put in over the next 5 years, and I put in 11% a year, I would get $34.64 in earnings per share for 2030 on a company like Adobe. The current multiple is around 16 times earnings, 16.7. I believe that's too low. And I believe Adobe should be trading, in my opinion, at least around 20 times earnings. But to keep it safe, I'm going to use 18 times. So in case Adobe does decelerate in growth, we put in 18 times earnings. I think that's a little bit safer. So if I take the current earnings per share for 2030, which we calculated, of 34.64, and I time it by 18 times earnings, this is like $623 per share. If I want to get it double over the next 5 years, which is what I aim for those stocks, this is $311 per share, which is around 14% from here. So for me personally, on 18 times earnings, which I believe is conservative, Adobe is a buy around $310, $311 per share. If it gets there, to me, Adobe would be a very interesting buying opportunity, especially relative to the overall market at this price. I think it's a little bit expensive for the market, but Adobe relative to the market, especially under $310, under $300 would be a very interesting opportunity for the balance sheet, for the company, for the growth, for the reach of the business model, 3 trillion PDFs. I mean, to me, it's a very interesting business, and I would really like it around $300 or below. Now, the third one, which is a very interesting one, and this is Procter & Gamble. This is one of the legacy businesses in the United States. Everyone loves it. Recession-proof stock, retirement stock, dividend stock, anything, you just name it. The stock is also down. It has done nothing over the last year. It's trading at 52 weeks low. They have the most popular brands you pretty much heard of, like Tide and Bounty and Always and Dawn, dish soap and Fairy and Ariel and Gaines. They have all the brands. They have pretty much a monopoly. Head and Shoulders for hair and other skincare, and Gillette for grooming, and Oral-B and Crest and Quill and Pampers for, and Always. They have everything. They have it all. They pretty much have it all, and they have everything you could want. Now, this company has been experiencing massive competition, and they don't have the pricing power that they used to. And you can clearly see it from the company's financials. Organic growth up 1%, earnings per share up 1%. It's really so bad that they had to include some kind of a metric I've never heard of, which is adjusted free cash flow productivity 75%. I don't know what this is, but to me it looks nice on paper, 75%. But everything else is like terrible. I mean, it's like a company that's that's trying to stay alive. And you could clearly see it from their baby, feminine, and family care segment. This is historically the strongest segment of Procter& and Gamble. Now it's not the strongest segment at all, where organic sales are declining 1%, organic volumes are declining 2%, net earnings declining 12%. This is just in the baby and family care segment. This is one of the strongest segment where a lot of families were willing to pay up for those supplies because they were, really good supplies for their babies and for the family. Now they're not willing to pay up, and there's so many alternatives where you have a lot of the younger generation, for example. Maybe they don't want to spend a lot of money on Gillette. They watch some influencer on YouTube. He's promoting Dollar Shave Club or some kind of website for like $2 or $5, and it's a good one. And they go buy it, subscribe to it. They don't want Gillette, or some kind of other kind of shaving cream or whatever it is. And it's the same thing with Oral-B and Crest. They say, oh, there's some kind of other brand that makes your teeth whiter with some influencer, and then they go buy it. Same thing with, let's say, Pampers. They buy Pampers, but then they go on Amazon. Amazon has their own brands that is $5 cheaper than Pampers. They say, oh, I'm going to take the Amazon brand, So the whole game is changing, and Procter & Gamble does not have the pricing power that Pepsi and Coke have. Now, the company does have a dividend. The dividend is like 2.7%, and it's a pretty good dividend, and the dividend is covered. The free cash flow yield is like 4%. The dividend is 2.7, so this is a good payout ratio, like 65% payout ratio. So I'm not worried about a dividend cut with Procter & Gamble. They've been paying it for like 135 years, and they've been increasing it for 69 years. So I'm not worried about Procter & Gamble at all. But this is, again, you're getting like a 2.7% dividend, 1 or 2% earnings per share growth. I mean, it's really terrible, guys. And you're not getting any kind of a discount at all with the company. I mean, 22 times forward earnings, the average is like 23.9. So you're not like getting a major discount. Like if Procter & Gamble was trading at 18 times earnings and the average is 24, I'm like, okay, I buy Procter & Gamble at 18 times, 1 to 2%, maybe I can take it, and like a 4 or 5% dividend, like what Pepsi was, what I was talking about it. And then maybe it reverts to the mean, I get a multiple expansion, I get a 5% dividend, but a 2.7% dividend, 1 or 2% earnings per share growth, and no room for a multiple reversion to the average or the mean, to me, it's not interesting at all. And they're guiding for mid to high single digits for earnings per share, but they haven't really been able to achieve it. And based on the dynamics, I don't believe they were able to achieve it. So for me personally, Procter & Gamble is not a buy. I mean, it maybe is on a short-term basis, like it looks like good swing trade, in my opinion, on the charts. It looks good, like it could bounce or something, but I would not hold it for more than a year or 6 months or even 2 years. I mean, to me, it's definitely not a good long-term investment. There's way better dividend stocks, way better opportunities in this market. But that's just my opinion on Procter & Gamble, Adobe, and my favorite one, which is Eli Lilly. That's just my opinion. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.